This is Street Signals, a weekly conversation about markets and macro brought to you by State Street Markets. I'm your host, Tim Graff, head of macro strategy for Europe. Each week, we talk about the latest insights from our award-winning research, as well as the current thinking from our strategists, traders, business leaders, clients, and other experts from financial markets. If you listen to us and like what you're hearing, please subscribe, leave us a good review, get in touch. It all helps us to improve what we offer. With that, here's what's on our minds this week. In both our Year Ahead Outlook podcast from December, as well as the rundown of consensus risks for 2026 that I did in the first podcast of the new year, the US dollar featured heavily, and it kind of has to, given this is a macro-focused podcast, and the dollar is typically the focal point around which FX markets trade. So it's with good reason that this week we're going to take a deeper dive into a really interesting new quantitative methodology that we're developing and using to forecast returns in the dollar index, or the DXY. We haven't talked about this methodology on the podcast yet, at least I don't think we have, but a lot of this is work that is the brainchild of Mark Kritzman. He's professor at MIT Sloan School of Business, our longest-standing academic partner and co-founder of State Street Associates. Mark's not on the podcast this week, but he has spent the last few years working on applications of techniques under the umbrella of what we call relevance-based prediction to a variety of real-world scenarios. He's worked with folks like Will Kinlaw, David Turkington, and Megan Zozonis from SSA on these applications. And today, we're very pleased to have Meg on the podcast to talk about a paper that she's just written with Wendy Gao, also from State Street Associates. This is Meg's debut appearance to talk about her work. We've also got alongside her Michael Metcalf, Global Head of Macro Strategy, who is back on the podcast to talk about the dollar view and this first release of forecasts that are given to us using techniques of relevance-based prediction. Michael and Meg, welcome to you.
Hey, Tim.
Mr. Graff, how you doing?
I am great. It is excellent to talk to you both this week. Meg, it's your debut appearance on Street Signals, so I think it's only fair you get to go first. In very broad strokes, can you walk us through what relevance-based prediction is, particularly what are its benefits and maybe any shortcomings that we might need to be aware of?
Yeah, absolutely. And thanks for having me, Tim. This is great. So relevance-based prediction. So this is a new approach to forming data-driven prediction. And it's an area that I've been spending many years working on, along with one of our academic partners, Mark Kritzman, as well as the head of State Street Associates, Dave Turkington. So this is actually a bit of a passion project for us over the last 5 years or so. So at a really high level, the way that relevance-based prediction, or I'll just say RBP, the way that RBP works is that it forms a prediction as a weighted average of past outcomes, where the weights on those past outcomes are based on a very precise statistical measure that we call relevance. So relevance then is determined by the predictive variables. And what it does is it measures two things about past observations. It measures how similar those past observations are to today, again, based on the predictive variables. And then it also captures the informativeness or unusualness of those past observations. And this is based on information theory, which says that more unusual observations tend to contain more information. So we measure this relevance using a very precise measure called the Mahalanobis distance. And so intuitively, the way to think about how RBP works is that it's looking for past environments that are similar to today, but also unusual and therefore informative. And it forms a prediction by essentially extrapolating from what happened following those prior episodes. So I think it's actually a very intuitive method that in a lot of ways aligns with how humans kind of make projections or form views about the future by relying on past memories and past experiences that they can recall. There's a lot of advantages to relevance-based prediction. I probably don't have time to get into all of them here, but I guess maybe just to summarize maybe the headline kind of advantages, I would say that RBP can capture really highly complex relationships like those that we see in the economy and in financial markets, complex relationships that are just beyond the reach of, linear regression analysis, for example, but in a way that's highly transparent and more theoretically justified than machine learning algorithms, which are the techniques that people have tend to turn for to model complexity. So I guess maybe just to lean into the transparency point a little bit, when we form a prediction for each individual prediction, we get a lot of insight into how that prediction was formed. So for one, RBP offers transparency into the expected reliability of that prediction based on the strength of patterns in the data. And that's what we call fit and how we measure conviction. Two, it tells us how each past observation informs the prediction. So we can see what the relevant periods are historically. And then three, we can also see how each predictive variable contributes to the value and reliability of the prediction. So you can imagine that all of this transparency really allows you to see how the data is being used. And then you can, overlay your own views and perspectives on top of that to see if you're confident or how you interpret the prediction.
You've mentioned the Mahalanobis distance, which we actually have talked about a little bit on the podcast before. This is the turbulence index methodology as well. That's one application of that statistical technique. But as I mentioned in the introduction, we actually have already thought about RBP in some other contexts. And, this episode is very much about that application to forecasting the US dollar. But I wanted to see, you mentioned it has been used to look at things like economic relationships. And I know there's some other work you guys have done over the years. In fact, stock bond correlation is something I've actually worked with you on a couple of years ago. I think one of the very first iterations of this.
Yeah.
Can you talk about some of the other applications you've done so
far?
Yeah,
absolutely. So RBP is completely general. So you can use it to predict anything that you want as long as you have the data. So it's the same way that you take your X's and your Y's with a regression. So you can use it for anything really. So we've been working on this, as I mentioned, for over 5 years now. I think our first application, the very first paper that we wrote probably back in 2019, was using it to predict factor returns. And then since then, we've looked at using it to predict the stock bond correlation, as you mentioned. We've used it to predict stock market volatility. We've used it to predict a regime-specific portfolio construction input. So using it to come up with kind of long-term forecasts of asset returns and volatilities and correlations that you would then use within a portfolio optimization or construction framework. More recently, of course, the US dollar, which is this piece. So those are, I think, some of the financial applications that we've done. We've actually also done some fun non-financial applications as well over the years. So, for example, we've actually used it to predict the outcomes of US presidential elections. And then we've actually done some fun sports stuff predicting player outcomes for NBA players. So again, totally generalizable. And over the years, we've spent a lot of time enhancing the framework and the methodology, and as well as the applications that we've been able to apply it to.
Thinking about the work done thus far that I'm aware of, and of course the new work as well, I think this came out to me in reducing things to the most relevant examples to use those for predictions. The natural question I have is about sample size, and how do you address any kind of small sample size concerns that might come about from only focusing on the most relevant periods?
Yeah, so that's a great question. And actually, one of the other virtues of relevance-based prediction is that it's quite resilient to overfitting. Let me take a step back here on the methodology. So RBP is prediction specific. So what that means is every time we form a new prediction, we tailor the choice of relevant observations that we want to focus on, as well as the predictive variables that we're going to rely on. And this is a process that we call grid prediction. So in this context, and to your point, one way that we could be concerned about overfitting is if we were to focus on too small of a subsample of relevant observations when we form our prediction, right? So there's a trade-off there. To some extent, we might want to focus on a subset of observations because there might be stronger patterns or relationships among those observations. But then at the same time, we could be potentially introducing noise because we're relying on a fewer number of data points. So to guard against this, what we do with grid prediction is we rely on the measure that I briefly mentioned earlier called fit, which helps us to basically optimally balance the patterns we're seeing in relevant observations with the noise we might be introducing from focusing on a small subset. So this is something that just naturally happens in the way that we've constructed the methodology. And so again, just to emphasize this prediction-specific nature of RBP, which is another one of the key virtues, what this means is that in some environments, if there's a lot of, historical precedence in the data for the environment that we're predicting, then we might want to rely on a larger sample of observations. But then there'll be other circumstances, maybe a crisis or something really unusual where we just don't have a lot of historical observations. We want to focus on a subsample, but fit helps us make that decision and it'll also help tell us how reliable we expect those, forecast to be out of sample.
Got it. Got it. I'm going to come back to the notion of fit in a
Mhm.
moment, but I want to start to talk about the current project, which is looking at a medium term forecast for the US dollar using RBP. And I wanted to start with the variables, kind of what goes into the process, what factors are you considering to determine dollar directionality over the medium term?
Yep. As you mentioned in this publication, we're forecasting the 6-month return of the US dollar versus a number of individual currencies, and then we have our DXY basket. So the predictive variables that we use, so again, these are going to be the variables that determine relevance, right? So the 12 predictive variables that we use, I would categorize them in a couple of different buckets. So there's 12 variables. A few of them are aligned around kind of your typical currency factors. So different measures that capture aspects of currency valuations, carry, trend, equity differentials, which is one of the key factors that we like to look at. We also have a few variables in there that capture different economic conditions. So differences in growth, for example, between the dollar and the partner country or currency. And then, of course, we also have some of our proprietary indicators in there, namely some of our investor behavior indicators. So looking at investor flows and holdings into the currencies, as well as turbulence, which is our measure of market unusualness and risk among G10 currencies.
Okay. And to circle back then, to put it maybe a very quantitative method into qualitative terms, can you, for this particular example of the application to the dollar, talk about the conviction we have in particular views, how that's determined, and maybe for someone who is less quantitative, such as myself, how would you qualify that and put it into more qualitative terms?
Yeah, absolutely. So conviction is a core part of the relevance-based framework. We use that analogously with the term fit. So we measure conviction with fit. What is fit? So fit tells us how strong the patterns are in the data, right? So every time I form a prediction, I have all of these historical observations. Each of those historical observations has a measure of relevance that tells me how important it is to today's environment. Each of those observations also has US dollar outcomes. And the combination of those forms my prediction. And then what fit tells me is essentially how aligned those relevance and outcomes are among those observations that I'm relying upon. So what that's going to tell us is if there's kind of consistent patterns. And if there's consistent patterns, then we should be more confident in our prediction because it means that there's, again, a lot of historical precedent for what we're seeing. And there's kind of consistent US dollar outcomes. So that's what we call fit. We also refer to it as conviction in the piece. And we find that this does provide a very effective measure of reliability out of sample. So again, we know fit at the time that we form the prediction. So before we even know the outcome that we're predicting. But what we do find in different tests that we've run and among other applications as well is that predictions where we see the highest fits do tend to perform better out of sample than those that had the lowest fits. And I think another way to think of this is that ultimately, when you're using a data-driven approach, you're limited to the data that you have, right? And there's going to be certain environments where that data is really good and really helpful for forming your prediction. There's going to be other environments where maybe, there's not as many patterns and it's not going to be as effective at forming a prediction. And so fit tells you that in advance and tells you how much confidence you should have. And so that's a really core aspect to the RBP approach. And I should mention that fit is completely prediction specific, and it's something that you can't get with any other prediction technique where everything's usually at the model level and it's an average. So we're all about fit. It's a really valuable aspect of RBP.
Well, I think it's therefore fitting that we now turn it over to Michael to talk about the current dollar view and what's coming out of that and the baseline kind of consensus outlook for that. So Michael, let's turn it to you. Could you sort of level set for us and actually take a step back and talk about what is actually the consensus outlook for the dollar over, say, the next 6 to 12 months?
Obviously, it's changed an incredible amount, compared to a year ago when, our metrics suggested that investors were very overweight the dollar. If we were scoring dollar holdings, they were 88 out of 100. We do the same thing today. They're 13 out of 100. And that tells you that, the consensus trade for 26 is to continue to expect dollar weakness. The harder thing now, I think, for 26 actually is to hang on to a negative view because there's a concern that it's oversold and is the consensus idea. So Yeah, the consensus, I'd say, in terms of investors' view on US assets, the view on the dollar has changed more than anything else, I would say.
How does that line up with our view? We, of course, put out year ahead views, we put out short term tactical views. In what ways do the features that you perceive within the broad market consensus dollar view either align with or maybe contrast with the views that we have and the things we're talking about using, particularly some of our indicators? What stands out to you there?
I think obviously within our indicators, we focused an awful lot last year on hedge ratios and in particular within that. And obviously with hedge ratios, we can get really quite granular and look at the location of the investor doing the hedging and what asset class they're in. The thing that we focused on a lot in 25, and I think we'll continue to do so in 26, especially right now, given some of the geopolitical tensions that we're seeing, is foreign investors hedging on US equities, even though our aggregate holdings metric highlights that the dollar downside view is consensus. The hedge ratio on US equities by foreigners is only at 21%. It has gone up a little bit compared to where it was last year, but if we think in the pandemic that indicator was above 30%, it shows that there is some dollars to sell still. And so even though it's a consensus and crowded trade, that there is potentially more to go. And then I think in terms of drivers, as well as things like potential interest rate differentials and the Fed delivering cuts while others are on hold, there is this kind of return of policy uncertainty, which has ebbed and flowed in the last 12 months, but is certainly it certainly seems to be flowing again right now. And so that's why both in our asset allocation and in our weekly strategies, we are still underweight dollars.
Does valuation come into that as all? I mean, we had a big dollar decline last year, of course, and as you mentioned, it's the consensus for this year as well. And I'm just wondering if valuation fits into that construct at all in your thinking.
It depends on what currency primarily, and I think as soon as you talk valuation, you're immediately drawn to the yen. The yen clearly is significantly undervalued against the dollar. I think the euro is much closer to fair value. I think at various points, at least relative to interest rate differentials, last year, the euro was trading at quite a significant premium above valuations relative to where it could have been with rate differential. So I think the valuation case is very clear in the yen. But again, obviously right now, the yen is experiencing policy headwinds and uncertainty about policy in its own right because of the election risk. So valuation, yes, a big case for the yen, but not one that's currently a major factor with those other factors driving it more.
Okay, well, we're going to now shift to using the relevance-based prediction methodology that Meg went through. And we will get to some of these sort of more granular dollar versus yen, dollar versus euro type of views. There was a little bit of foreshadowing in that question. But I wanted to just get the big picture answer from you. We're about to start publishing the output of this methodology and what it means for the dollar in the coming months. So just very high level, what is the first edition of this document going to say about dollar directionality in the coming months?
It's really helpful to get a grounding from this quantitative process that obviously is not opinion based like the prior views that I highlighted. So it's good to get kind of affirmation, because actually the inaugural edition is going to be dollar negative, at least at the DXY level. And that dollar negativity is actually focused on, interestingly, is focused on both the euro and the yen. And the one thing I should just note is that while it's the inaugural edition that we're publishing to clients and launching, we have done 3 or 4 months of this now, and it has been negative on the dollar in those prior editions as well. We sort of do these as kind of practices to get used to the how we're going to write about it and how we're going to interpret the output. And the one thing I can say from that is it's been fairly consistent in being negative on the dollar in terms of the 6-month outlook, but the conviction levels have been changing, and actually some of the currencies at which it prefers to see dollar weakness against have morphed a little bit over time as well.
And so what is the conviction level in the current outlook?
Actually pretty good. So the DXY conviction is in the 60th percentile. Underneath that, and the idea with the piece is that the headline obviously is on the dollar and predicting the DXY, but then actually we go into the pairwise detail, which gives us some interesting granularity, some interesting narratives. The highest conviction in percentile terms is the prediction of dollar weakness against the yen, which is in the 74th percentile, and then the euro is just a little bit behind in the 72nd.
One of the things that I always find really interesting in previous applications, things like stock bond correlation was, I think, the first time I ever used this. And that was, for me, sort of the aha moment, especially given I love thinking about market history, and it sort of married the qualitative with the quantitative in that you can go back and look and see what periods most align with the current outlook. What are the most relevant points of comparison? And that's really what I'm curious about here. This negative outlook for the dollar that we would have, irrespective of this methodology for this year, coupled with the view of bearishness in the DXY that comes out of the RBP methodology. What sort of relevant historic periods are we talking about and using to make this forecast? What stands out there?
Well, actually, Tim, you know what I'm going to do? I'm just going to use this as an excuse to mention a piece that we did around the turn of the year as well, because you mentioned stock bond. We used this methodology to try and predict stock bonds into 26 and historical periods. And what we were using to do the forecast was investor holdings of equities relative to bonds, which, as we all know, are incredibly extended right now. And it came up with this really fascinating result, which is that all the historical relevant periods to predicting stock bond in the next 12 months, are actually either pre-bubble or post-bubble. So what that means is that your return predictions on average are almost zero, but actually it's a totally bifurcated distribution with either really good outcomes or really bad outcomes. So that actually goes back to some of your original stuff on stock bonds. So that's a great application of it. But let me actually just answer your question on the dollar directly, because there's two really interesting things that for me at least. The first is on the euro dollar prediction, which, as I noted, there's a reasonably high conviction here, and as Meg mentioned earlier, when we have high conviction, the hit rates, at least in terms of direction, tend to be pretty good. And what it's gone back through in the methodology and found in terms of most relevant periods is actually they're all very recent, interestingly enough, for Eurodollar, and in particular around Q1 of last year, so kind of March 25. And the really interesting thing is that we're obviously not feeding the methodology any market narrative information or anything like that. So there's nothing in here that would tell the model that actually the most relevant period right now would be a period when we were talking about tit for tat tariffs. Oddly, it seems to have kind of gone back to that period and thought that it was relevant for the next 12 months, which, given the way we seem to have started the year, that feels to me to be incredibly prescient. So, a time of high policy uncertainty and potential volatility in markets, it's gone back and found those periods. And then curiously, and this is why I think this is the value of looking at it on a pairwise level rather than a regime as a whole, is that in dollar yen, the relevant periods it picks out are actually the end of, it's November and December 2016. And then actually, when you look at the chart and the piece, it's actually highlighting quite a bit of 2017 as well as being very relevant. And that was a period where you had initial significant yen weakness followed by very gradual yen strength. There's an interesting historical analogy there, which of course is that was Trump 1. And the original period of yen weakness was driven by dollar strength on the kind of the Trump reflation trade, or the anticipation of it, which was then disappointed, and then dollar yen gradually came back down after that. This time around, of course, it's much more driven by expectations of Japanese reflation, but then also, in particular, a decoupling of dollar yen from rate differentials. And I think that the idea that this methodology is highlighting that period is most relevant for the next 12 months is maybe an indication or an expectation that the yen will come back in line with rate differentials as it did during that prior period. So it's just interesting to me that it picks out different factors and different historical time periods for the different currency pairs.
It's fascinating stuff. It's that marriage that I love between quantitative techniques that are, as you put it, agnostic to narrative or ignorant of narrative, and yet being able to go back and have this discussion that we've just had, which is why currencies move, what stopped them from appreciating, what stopped them from depreciating. That historic parallel that comes out of this, I think, is really interesting. When are we going to get these updates? How often will they be? Where can people find them? Can you walk through this?
Yeah, of course. So we've just put out the first one, and look, like I said, we've done 3 or 4 trial ones already, and we're going to learn as we do this. And looking exactly as you say, Tim, it's getting these empirically robust historical analogies, and then actually for us, for the humans writing against the machine output, if you like, it's going to give us a lot of color about and a lot of confidence in what are the right historical analogies. This is also much more medium term than many of our pieces. the outlook here is 6 months, but we're going to update it every 3 months. You should look for this in the second week of every new quarter. So the next one will be mid-April, and we'll keep updating. And the one thing I would say is that, and as we've talked about, actually, we've already applied this to stock bond correlation. We've applied it to stock bond returns. We're now doing it to FX, but we're really looking to apply this to many other asset classes and also economic variables, because it's the same kind of rationale to do it, is to find what are the right historical analogies and how confident should we be in our predictions. Because the other thing, obviously, for obvious reasons we've not talked about it, but there are also predictions in this piece that we're not confident in. How many times do you hear a strategist say, well, I'm just not confident in that? I like the honesty that it brings to the and transparency, as Meg said, that it brings to the prediction process. So once a quarter on the website, and who knows, Tim? It might occasionally feature on Street Signals.
It may well. You keep this up, and you might come back. Fascinating stuff. Michael Metcalf, thank you so much.
Pleasure as always, Tim. Thank you.
And Meg Cezonis, thank you so much.
Cool.
Excellent.
Well,
Awesome.
thank you so much,
Appreciate
Tim.
It, Meg. Thanks for listening to Street Signals. Clients can find this podcast and all of our research at our web portal, Insights. There, you'll be able to find all of our latest thinking on markets, where we leverage our deep experience in research on investor behavior, inflation, media sentiment, and risk, all of which goes into building an award-winning strategy product. And again, if you like what you've heard, please subscribe wherever you get your podcasts and leave us a review. We'll see you next time.